Mitch Kramer and Trey Talley bring you Fluent Financial's February webinar for 2024. Obviously, I'm not in the office today. Trey is going to be guiding us through the majority of this webinar. We got some interesting information we're going to share with everybody today. We've been talking about this recession for many months, and it just has not gotten here yet. And the longer it waits to get here, the deeper it's going to be. There's just some disturbing data that's just not being reported. I know the big magnificent 7 stocks have done well, but that doesn't make the whole market. So I'll go ahead and get this turned over. And Trey, I'm going to give you control here so you can take over.
Bear with me here.
Yeah.
Let me know when you can see that, Mitch.
Yep, looks good. Go ahead and do, there you go.
All right, perfect. Okay, all right, let's begin here. So we've got some compliance information. These here are our opinions of Fluent Financial. So we're going to start kind of how we always do here. Looking at markets, kind of taking a look here from the beginning of the bear market in January of 2022. And Mitch, can you see my screen there?
Yep, I can see it just fine. You've got to go back to the presentation screen. You've got the side screens on there. Just go current slide.
Can you see everything okay?
Mm-hmm.
Great. So thank you. Technical difficulties aside, we're going to take a look here where we are in markets and kind of where we're along in the roadmap of the hope cycle. Disinflation has paused, meaning inflation coming down to a more tolerable level. That has come down to an intolerable level now, and inputs to inflation are moving back up. So we really haven't been worried much about a second bump in inflation, much like we saw in the 70s. Those fears are percolating a little bit. And kind of going to the sentiment that Mitch was talking about there with kind of some of the mania-like areas of the market where they've abandoned fundamentals. Where I'm reminded of the quote that says, "The market always does what it should, but never when it should." And that is certainly most likely the case today. So when we look at the leading economic indicators, so economic data that shows us where we're going, they index it here, and so we're still sitting at about -7% year over year. Those are levels that are consistent with the recessions going back to 1960. So the decline is moderating a bit, as you can see by a small uptick, but the index itself is still moving lower. And so when we try to assess the health of the economy, the picture is clear. It's weak and getting weaker. Markets can do their own. They say the market is not the economy. And it's hard to kind of reconcile the two differences, with markets being at all-time high and the economy being quite weak, especially in a number of areas, unless you start with the first principles of there's a bubble going on. And then it makes a little more sense. So the 2023 has spilled over into 2024, with market leadership being led by the Magnificent Seven, a very narrow group of the market that is trading mostly off of technicals instead of fundamentals. So on the left side of the chart here, we see the Dow Jones is up about 2%. The NASDAQ and the S&P are doing quite well this year. The equal weight, that's up just over 1% as of the close of the 21st. So that would be like, what is your average stock doing? Well, it's up about 1% this year, pretty paltry. The NASDAQ, or excuse me, the bond market is down again this year. The Russell 2000, which is very leveraged to the economy, that's also down over 2%. The 60/40 is just up over 1%. So our portfolios are kind of hanging in there. The good thing about, the unique thing about the past 12 months is actually international has been keeping up with domestic there. So that's a good, that's something we got constructive on last year. That's been good. So we're still defensively postured. We talk about the weakening economy and stocks being very richly valued here. So we're defensively positioned. So we're able to participate in the game, but we're not out there running. And so that's kind of what the portfolios look like here. So hope cycle, we've got the current employment portion highlighted here. That's where we think the most recent area of weakness for monetary policy has landed. So employment is kind of where we'll spend a little time in this webinar talking about, just getting a picture, getting familiar with some of the data there. And diving in, we can see here that the housing market, so we start with the home builder sentiment. In this reading here, anything below 50 is contractionary. And so we're still contracting at a reading of 48. It's doing a lot of chopping around. It actually looks pretty similar to what mortgage rates are doing. When mortgage rates come down, you look kind of flooding back in the market. I know anecdotally, I see a number of houses popping up over the past 30 days in my neighborhood. Maybe that's the same for you. But home builder sentiment remains quite weak. We look at that alongside building permits. And so building permits really for the past 5 months have been around this 1.5 million annualized level, not really doing a whole lot. There's a lot of supply of multifamily coming online in 2024. The single family market's still idiosyncratic in that the existing supply is not present and home builders are kind of stepping in. But in the multifamily space, I think one of the statistics that I heard was, particularly in PA, in Philadelphia, they have 16% of their entire multifamily supply coming online in 2024 here. So that'll help with rents, but ultimately that is going to slow construction and home building activity in the future, especially alongside high rates. So housing continues to be a pain in the economy. Manufacturing new orders. So we got a reading here of 52.5. So anything above 50 is, again, expansionary. So after over 12 months of decline, manufacturing new orders are starting to pop higher. And this did come on the back of a post-FOMC meeting where the Federal Reserve talked about rate cuts coming this year, and the market started to get ahead of itself. Participants started to get ahead of themselves. So a lot of purchasing managers trying to shove in some new orders with the anticipation of lower rates there. This is generally not what we want to see. Manufacturing improving off of a bear market where the economy's really in a trough. Those are great things. That means we're healing. Manufacturing accelerating while inflation is still above 3% for the past 7 months now. That's problematic. That means the inflation that you and I all want to go away is just not going away yet. And in fact, it could get a little bit worse. So we want to keep an eye on this here.
Yeah, Trey, why don't you talk a little bit about what's going on in Germany and China?
Yeah, absolutely. So big manufacturing hubs globally, Japan, Germany, China. Japan and Germany, we got word last week that are in a recession. They're in a technical recession. Their GDP has declined for 2 quarters in a row. China, if we could get good quality data out of there, it would probably show that they are in a technical recession as well. So manufacturing, when we put all the pieces of the puzzle together, is still very, very weak, and it is dragging some of these economies down. It's hard to envision a scenario where U.S. growth can be resilient in the face of such weak global economic growth. Australia's unemployment rate is up over 0.5% in 4 months alone. Manufacturing. There are some bright spots that are emerging, so we'll keep our fears tempered, both for inflation and for weak growth. But that's kind of the update on the manufacturing portion.
Talk about services, Trey. Looks like the trend has been kind of negative for the past 3 or 4 years. It's kind of flatlining around this 55.
Yes, exactly. So post-COVID, a lot of goods spending, services were still locked down. Our money went somewhere, and that shifted towards services in 2021 and 2022. Services is still a bright spot in the economy. Again, at 55, it's still in expansionary territory, but it is moderating. It is normalizing there. And so we see that decline there coming. So that's one we want to keep an area on. If you can get in healing in the manufacturing sector while the services sector still holds in there, that would be great. Thus far, we just see a steady decline there towards recessionary levels. So turning our attention to corporate profits, they have started their decline. Companies have really spent a lot of effort to try and protect earnings. The last thing they can do is cut labor. We'll talk about that in a minute. But earnings here really are moving sideways. And so there's all the lift in the market that you have seen, believe it or not, has been multiple expansion, meaning valuations have just gotten more rich. The earnings of the companies, they have not done anything. And so that's generally a house built on pretty weak legs. We just want to be careful and mindful of that. And lastly, employment. Initial claims for unemployment here remain quite low at just over 200,000. And so one of the anecdotes I heard was out of California. Their current, post-COVID, all the states really tightened the qualifications on unemployment insurance because there was such a drain through COVID. And particularly in California, if you were able to get unemployment insurance, I believe it comes from something like $11,000 average income, which is about 25% of the poverty level in California. And so if you're an employee right now in California and you're getting laid off, which you are, we'll show you that in a second, well, your income that you'll get from the government is kind of paltry. And so what you're doing is leaning towards kind of the gig economy. You're Ubering, you're doing DoorDash, you're delivering pizzas, whatever you can do. You're getting part-time employment, self-employment. That's at an all-time high. We'll show you that as well. And so that's a good thing. It does take some pressure off of the states. I'm not a big government person, so I do like that portion. But it does give us some explanatory material in terms of why initial claims is really kind of sitting here at 200,000, yet the unemployment rate here and globally is rising, which it is here at 3.7. Unemployment is rising. It's up almost 0.5% off of the bottom there. Unemployment, as you can see, it generally it does not stop on a dime. It does mean revert. Low levels give way to higher levels. And once they start moving one direction, they generally keep persisting that way. So as we're rounding the corner here going up, the next move would be higher unemployment. We think it'll at least get to 5% or so. So we're just beginning that journey. So this is not part of the hope cycle. This is one of the other metrics that we wanted to include here. So this is out of the Kansas City Federal Reserve, and they have a labor market conditions index. It's 24 inputs. And this measures in a very, very broad sense everything from the unemployment rate to initial claims to hourly earnings, quit rates, hire rates, participation rates. It's an all-in metric. And so when we look at this, it really just paints the same picture that it has over other prior cycles. The labor market is deteriorating and layoffs generally ensue, which happens in a recession. So that's kind of the trend that we see there. So we thought this was a really good picture of kind of an all-in. What's the labor market doing? Well, it's quite weak and it's getting weaker. And that's generally a problem.
And Trey, this next chart I think is really important because you're starting to see a lot of layoffs from very large corporations. Twitch, iRobot, LA Times, Washington Post. I guess nobody's reading that garbage anymore. Do you want to share some of the others?
Yeah, exactly. So on the left side there, the font is a little small. I'll read a couple of them out loud there. There's a couple of the companies that have tracked and announced layoffs just since the beginning of this year. And then on the right side there, you kind of have it all aggregated into some columns. So you can kind of see the trend. October was a big month for job cuts. January was obviously an outsized month there. We got a couple bits more data here over the past few days. And this February, this green bar here, is going to eclipse November and December of last year in terms of job cuts. But yeah, adding to Mitch, what Mitch was saying there's a lot of companies that are laying off workers. They're big companies and they're laying off material amounts of their workforce. Charles Schwab at 6% of their workforce has been cut. BlackRock 3%. Citigroup cut 20,000 employees. Estee Lauder and DocuSign cut 5 and 6%. Let's see. Discord is 17%. Lastly, Cisco 5% of their workforce was cut. Some of these are smaller, and some of these are pretty sizable. And some of them will happen immediately, and some of them will happen over a couple of quarters. We kind of see a general trend that the sentiment of through the boardroom, all of the finance offices, through all these corporations through the yes, who last year in 2022 said, well, we'll hold on to labor. 2024, they're striking a different tone. So this here is state level unemployment. So we have 4 states here and their respective unemployment levels here that we're looking at. So this blue line here, we've got a light blue and a dark blue line. The dark blue line is California. The light blue line is New York. The dark red line is Texas, and we've got the light red line that is Florida. So 4 of your big states here for GDP, and we kind of get a picture of what their unemployment rates are doing. We see this here on the right side here. And so we see all of these states off the bottom, rising unemployment, trending much like they have in prior cycles. And so we're just rounding the corner. Some of them are ahead of others. Unemployment rate's 5.1% in California, and that's up almost over 0.5% from its bottom there. We see it's, when we disaggregate it and look at it on a granular level, when we pop open the hood, we see that the big powerhouses of the economy are laying off workers just like they have in prior recessions. They're doing it in unison, and it's happening. And it's now at a material level where it should catch all of our attention. So that's kind of what it looks like at the state level for the unemployment data.
And Trey, it's interesting. This next chart, when we look at it, you have full-time employment in gray and part-time in the orange color. Full-time hours are being reduced, but part-time is increasing. So companies are trying to cut their full-time people, cut overhead, and they may hire part-time people they don't have to pay benefits to, or contractors, so they can get the work done, but trying to protect their margins before they start taking a hit and have to start laying off people en masse. So this trend is not positive. It does not reflect a very healthy economy. This chart here, I think, is the most important one of our presentation this month. If it wasn't for our federal government, we would be in a deep, ugly recession. And this upside down triangle, it should be turned around the other way. And Trey's going to talk a little bit more about why that's important. But we've talked about this in prior webinars. The government and then healthcare were the biggest generators of jobs, specifically the federal government. And it's a double-edged sword. Yes, people are working, but guess who pays for the government workers? Everybody on this call. And a bigger government with more rules and regulations. We're a small business. I just found out about a law that was passed in 21 that they want more information about our business and firm, what we do. And they already have it through other agencies. But one of the other agencies gotten bigger and got more people. They're wanting more information. It's just more red tape that this administration is putting down on businesses, and it's not healthy. So Trey, why don't you talk a little bit about how this triangle should look?
Right. So last year, this is the cumulative job growth there and where it came from. Clearly came from healthcare, education, and government. We generally would want to see this triangle flipped right side up. It should be a triangle here, facing the other way with the north. But it's not. And so what that would mean is we would see construction and manufacturing. Those would be the sectors of the economy that would be leading job growth. That's good, healthy, cyclical activity. And in contrast, what we see is non-cyclical areas of the government leading job growth. And they were a big portion of it. And so the government coming in and printing a bunch of debt and pushing it through the system and hiring a bunch of teachers and all different positions in municipalities has really been the result in the story of 2023 jobs. The good news is, if you're a small government person, is that starts to abate in 2024. The growth in government jobs that will be funded by government money will be very small in 2024, and in fact, in 2025 it'll be negative. So we think that we've seen the big tide of all of that. But this just goes to show that last year, the story of jobs growth was really part-time workers who had to because they were either getting laid off or they were getting lost in inflation, and government coming in and hiring a bunch of people with post-COVID funds that are still out there and sloshing through the system. It really wasn't the healthy sign of job growth we'd want to see. So that's what last year looked like. We'll keep an eye on 2024.
Yeah. So, and before we get into inflation, Trey, people are saying, why are you guys telling us all this information about how bad employment is? It's very difficult to take your hard-earned money and put it in more risk assets as the market takes off in a bubble format. We've seen this show before, and it does not end well. And we'll talk about that here in a few slides. We're just still going to be cautious because this is not a sustainable market, and the market is disconnected from the overall economy. So if we turn our attention to inflation now, uh, the red part here represents energy, and that's been more of a deflationary pressure. But the core services, the gold bar, it's been very sticky and it's not coming down. The government, or the Federal Reserve, I should say, would like to see inflation at the 2% level here. It's been at this 3% level. And you guys all know this. If you go get dry cleaning, you get work done on your car, just services are still expensive. Thank gosh, 3 to 4 months ago, it wasn't this much, and even food costs. And it's very, very difficult for those costs to come down. And that's why the Fed has been more hesitant in cutting rates, because they can't get core services down. And all the insurance costs, car insurance, homeowners insurance, car repairs, those prices are not coming down. They're continuing to go up. Trey, do you want to add anything to that?
Yeah, it's just there's all kinds of things in core services that we really don't think about, like tax prep services and laundromat services, and it's really hard to slow those things down. Once you get these thrusts of inflation, it's really hard to kind of unwind it. And to do it, classically, what you had to do is raise rates really high, lay off a bunch of workers, create some controlled demolition in the economy, and then slowly reflate things. Well, the Fed kind of has just been talking out of both sides of its mouth to try and get down inflation, but not lose the jobs. But the truth of the matter is, if you want to break down this 3% level and get down to something more tolerable, 2 or below, you're going to have layoffs. The Fed is starting to realize that. We've seen their language start to change a little bit. Kind of what we're looking at here is related to that prior inflation slide. So we have 2 panels. On the top panel, we've got the US CPI. That's the same chart we were just looking at. So this is your inflation rate year over year, 3.1%. This zone here that we have kind of in gray, this is where the Federal Reserve targets are. So above 2%, they get worried. They want to hike rates, slow things down, cool the economy. Well, we've been at 3% or above for over 7 months now. So the progress we've been making on inflation has really stalled. And in fact, when we contrast that with the inputs to inflation, some of the leading data for inflation, this is in this bottom panel here. So we've got an orange and a white line. They both represent both manufacturing and services prices. And so we get that from the ISM report, the same people we use for the new order slides in the hope cycle. And so what we see is both manufacturing in white and services here in orange curling up and now moving higher. 64 readings. So it's very expansionary for services. What this means is that the leading data of inflation now is turning higher at a time when inflation, headline inflation, has based at 3%. The Federal Reserve has been working here for over 15 months to try and get inflation down. They've been talking out of both sides of their mouth. That's why the market is up. That's why inflation is not back in target yet. So it's taking too long to get this nasty inflation out of the way, and now they fear another bump in inflation just like we saw in 1974. We're not there yet, but with these prices paid, inflation expectations, real rates, break evens, energy, all of these things are moving higher alongside shipping rates because of the disruption over there in Africa. These things are pushing inflation back up again. So at the time when they were just starting to talk about rate cuts, they're having to back it all up, try and not reheat the economy and set off another wave of inflation. Something we're watching. This is kind of a newer development, but we'll keep you updated on all of this here. But we have not been concerned about a reflation in the economy for a number of reasons. The energy weighting is very different. We're in a lot of supply of energy in the world, the different weightings of the CPI methodology. So at this point, I don't want to set off any concerns. This is the 1970s, but this is going to set us up for, we're not quite out of the woods yet. That's where we can leave that.
Yeah, and this next chart is the narrowness of the stock market. It's foretelling potential trouble ahead. So when we look at this chart, the top 10% of stocks versus the size of the entire stock market. If you look at this, and right now we're at this peak here, the prior two times this happened was 2000 and 1929. So the market is incredibly narrow. It's just like, very few stocks that are holding up the whole stock market. This is not a healthy condition. So on top of the labor information we just covered, and this information, again, we are going to be conservative because we don't want people to have a full big slide down as what's happened in prior bubbles before.
Right here. So this historic narrowness in the market, very, it's not a healthy sign. It doesn't mean you need to go buy a bunker tomorrow, but it generally means the stocks are going to have to work through this over a number of years. And it's 10% of the stocks that are out there in the U.S. market account for 75% of the size. It's a very big concentration that's happening alongside this next chart here. Which gives us a lot of caution at the same time the labor market's breaking. What we're looking at here on this chart is called an equity risk premium. All this is looking at, I can invest in stocks and I can invest in risk-free bonds. What is kind of my return differentials there relative to each other? This line, this blue line here in the upper portion and the upper panels, that's a healthy sign. That means you're getting paid to take risk. Anything below zero or even around zero is generally a pretty bad risk reward ratio. So kind of where we are now, we're at a negative equity risk premium, meaning the earnings yield on the S&P 500 is actually below the amount that you can get in risk-free treasuries right now on a 3-month T-bill. If we look back, we have to look back all the way to the tech bubble in August of 2000 to find those same types of ugly readings. And that was not a great time to be an investor in stock markets. The S&P went down almost 50%, and the NASDAQ went down over 70% over the ensuing years. That is not a forecast. That is just what happened. And so we see the same thing in July of 2007 when the market peaked prior to the great financial crisis. The equity risk premium wasn't even negative. It was just modestly positive at that point. So, we might be able to make the assumption that we're in a worse scenario today than we were then in terms of relative reward. This is what we want to see. March of 2003, March of 2009, March of 2020. This is when the markets troughed in these corresponding recessions. And we will get back there one day. Earnings will improve for the S&P and rates will come down. But right here, right now, you're not being paid enough to take risk in the stock market relative to your return. So we're kind of putting all these puzzle pieces together. You're not getting paid to take risks. The labor market is really deteriorating. The market's really concentrated. It doesn't really give you a warm and fuzzy feeling to go out and buy a bunch of stocks.
Yeah, and Trey, I think it's important to note that our clients in stock income and in some of our other portfolios, you've seen a lot of T-bills that we're buying and rolling them over 30 days that are paying about, 4.5% now on an annualized basis. And stock income for all of 2023, over 25% of that portfolio was in T-bills for the whole year and still generated over 8% annually. And that's what we told you guys we would be able to do. So we're very aware of what's going on here. We're just trying to find a much better entry point to increase the risk in the portfolio. But now it's time to kind of batten down the hatches and wait. So the
right,
next,
and yeah, those, yeah, absolutely. And those T-bills, I just want to say, they do a great. They're two-pronged. Yeah, we give up a little return, but we greatly reduce the risk. So you can actually meet your goals with much lower levels of risk. It's a really great time for this here. But I think you were going to talk here kind of about consumer delinquencies.
Yeah, and what's interesting is, the government pumped all this money into the economy, and the consumers are starting to not be able to pay their bills. So you look at this Equifax reports, you can just see it going up like a hockey stick with the deteriorating credit ratings. And you can see that happen prior to the recession, the Great Recession here. Not as much here, this is COVID, but it did increase a little bit. But the consumer is starting to be tapped out. I know in the Dallas-Fort Worth area and other areas of the country that have pretty good economic growth, the restaurants are still crowded. It's not like it was in 08 and 09, but we're just seeing another sign that the economy is faltering. We'll turn our next part of this to commercial banks. We spent some time last year about the regional banks, Silicon Valley Bank, um, and the other bank that went under because of too much risk in some of the startups in the tech area. But one of the areas that we're concerned about is commercial real estate. Commercial banks will have about 7% of their portfolio in commercial real estate, which is not significant. And you contrast that with the small commercial banks, you're looking at something that's north of 30%. And as these landlords are wanting their tenants to sign new leases, and a lot of these tenants have people working at home, they're taking less space or moving to find a better deal. We're going through that ourselves right now. Our lease ends in March, and the rates they quoted us a year ago are significantly less than what they are now because our building's in the same situation. So it's an advantage for us. But the regional banks are going to feel some pressure here as these buildings become more empty. And from a portfolio standpoint, we currently do not own any small banks or any large commercial banks at this time, but it's just another canary in the coal mine. And then, Trey, why don't you talk a little about the Treasury supply? And it's been a market mover, and because I think this is really important for people to understand the consequences of our government spending the kind of money they have been.
Absolutely. So the big government here, a lot of fiscal money floating around that had an impact on jobs last year. It had an impact on growth, and it's also having an impact on yields. And so currently when we assess kind of market temperature, it seems that the federal government debt levels right now are putting upward pressure on yields. So what we're looking at here on this chart is two panels. In the top panel, we've got the S&P 500 here, and in the bottom panel, we've just got a 10-year yield. And so we've got some red lines, red vertical lines here. And here's what this is marking. So going back to July 31st of last year, the Treasury came out with what's called QRA. They come out with every quarterly. It's called a quarterly refunding announcement. All this is just saying, hey, we got this amount of debt we got to issue. And the market either gives them a thumbs up or a thumbs down. I'm being silly. But in July of 31st last year, the market looked at the supply of debt that the U.S. government needed to issue, and it said, we don't quite have the appetite for that. And to make us, want to move into that, you're going to have to supply us with higher yields. So look what happened after July 31st here. This was this 10% correction we got during the summer in the S&P 500, a 10% correction here, and yields went from below 4% to 5% in a matter of months there. On October 31st, on Halloween, we got our next announcement here from Janet Yellen. And she saw what was happening in the yield market. She saw what was happening to stocks, and she said, we'll defer some of this supply until a little bit next year, let you guys kind of digest this debt here. And so that is actually the fumes the market has been running off of since that announcement. The supply of debt was compressed a little bit. The market took that as a good sign. So yields cratered from 5% down below 4%, and the market went on an almost 20% tear over this time. January 31st, we just had another announcement. We knew it was coming. All of our T-bond ladder folks, we were focused keenly on this for this reason here. We wanted to make sure we didn't get trapped down here in low yields. So on January 31st is the last red line here. The Treasury came out and they issued their statements on how many bonds they needed to supply. This time it was a lot. And the market, as you see from the yield perspective, really started to spike. So yields went from below 3.8, at 3.8 to over 4%, almost touching 4.3% here on the 10-year yield. About 50 basis points of move just within a couple of weeks. That's pretty drastic in the bond market. Stocks did not get the message. And so they've been fueled on their tech rally here, which helped them extend that rally. But if we were drawing from the analogs of the past, we'd expect markets to kind of soften up here on the back of higher yields. So our T-bond ladder folks, we figured once that announcement came out, we read it through it. We knew yields would spike up. We kind of got you on the sidelines here in T-bills. 4.5% or so is kind of what we're looking at on the 10-year. We're going to limp everybody else in on those T-bond ladders. That way you can secure some good rates, help yourself with fixed income, and especially in the ensuing bear market that is coming for equities. It'll help you in that environment as well.
Yeah, so really the bottom line is, yes, we're still moving towards a recession. And if you look at the red bars represent the recessions. This goes back to the 1990s. The orange line here represents GDP nominal dollars year over year. The green line represents employees and non-farm payrolls. And what you see happening here on the right-hand side, both of these are trending downwards, which is basically what happens, as you can see in the prior recessions, you see the same trajectory. So we are going to be heading towards a recession. And as I said at the beginning, the longer we wait for this recession to get going, the worse it's going to be. Anything you want to add to that, Trey?
Yeah, unfortunately, in its pursuit of a soft landing, the Fed has kind of created almost a stagflationary environment. It's kind of where we're headed. Generally, kind of can be a tough time in markets. Great news is we've been fortifying all along the way. We feel like we're ready for a number of scenarios. We're able to hit our targets, pull down that risk. Everybody sleeps a lot better at night, and we'll let the market kind of sort itself out in the ensuing months and quarters.
Okay, so as we kind of wrap up here, interest rates has been a big driver of what we've been doing with our bonds, our portfolios, T-bond ladder, et cetera. Right now, because of the inflation being more sticky, the Federal Reserve is not going to be raising rates during their March 20th meeting or their March 1st meeting as of today. Looks like the first rate cut will be in June. They'll probably have another rate cut in July, and they'll have one here in September, and then maybe another one in December. So going from 8 cuts to something significantly less, and that's because inflation is being so sticky for the reasons we articulated. If we have a recession and it gets going, you're going to see the Fed cut rates pretty quickly. But right now, this is what's anticipated. Now, this chart, you can look at it daily, will change daily, but this is the trajectory as what it looks like today. And to kind of wrap up our option heavy portfolios in terms of income, we talked about this a bit earlier. This is what we're targeting to produce on $1 million. This is the amount of income. This is what we've done trailing 12 months. And again, we're doing this with a pretty conservative amount of T-bills in our portfolios because we see what's going to be happening. So as we kind of wrap up, we talked more about, yes, the economy is still struggling. It's getting worse. It's not getting better. Employment still remains sticky, but we're starting to see cracks in it. Haven't seen the mass layoffs yet. Inflation is still a problem, and we're just going to be more conservative with our portfolios. And when it turns, it becomes more of a risk on trade. We will make that change, but right now we're going to keep things the way they are. So I'm going to go ahead and stop recording and go ahead and open this up for any questions. If you guys want to type one in the speech balloon, go ahead. Or if you want to unmute yourselves, you can ask a question. Trey, while we're waiting for some questions, you and I were talking earlier today about what do you think the odds would be that the Fed would move the goalpost and instead of having a 2% inflation goal, maybe raising it to 2.5?
So yeah, they're raising their target there. It could happen in the future. It would be done with a lot of research and debate. They're not going to do it now, though. For them to do it now would send a ripple of confidence. It's one of the biggest tools they have is setting expectations with forward guidance. So I think I'm going to give them the benefit of the doubt. I think they really do want to get rid of inflation. I think they've kind of fumbled it in some areas, but I think they're going to refocus, and I think they're about to start to peel some of those rate cuts back, get serious about getting inflation gone, and let's just get on to some better times. This has gone on for almost 2 years now, and over 2 years now, and I think they just need to finish the job they started. They'll keep the targets where they are, I think, maybe reassess in the future. But I think that's kind of how we see monetary policy going forward.
Okay, well, fantastic. Well, I don't see any more questions, so I guess we answered everybody's questions. But if you guys have some you want to ask offline, please email or reach out to us. We'll be happy to get with you. We appreciate your faith and confidence, and have a good rest of the month.
Thank you.
Thank you so much.